Apes and ape bets, welcome back to the channel. I hope you guys are having a great day. But here in this video, I do want to acknowledge when I think the MOAS will happen. And I know this is pretty generic. You've heard this a lot from me and other YouTubers. Every single AMC YouTuber has been wrong about this. But I think it's pretty easy to see now when we could expect to possibly see the MOAS. And I'm not trying to be your cheerleader here. I have a very large AMC position as well, and this is only my due diligence process. This is my thinking that I want to share with you guys. So by all means, if you guys think I am wrong, provide why you think I am wrong down below in the comment section. That helps me revise my theories, and I might not think of something that you guys post down there, and that could change the equation, because in economics, in investing, things can change on a daily basis. So it's important to keep revising your theories, and that's what we're going to do here in this video and give you guys the latest of what I am thinking in that timeline. So let's dive into it. If you guys find value out of this video or simply entertainment, hit that like button for me, subscribe to the channel, as well as make sure, like I said, to comment down below. If you guys also want access to all of our trades in real time and join a great trading community where you can source any information, any trades that you want, ask any questions. If you need a mentor, if you don't know where to start with options, that is what that is for. We hit the Facebook puts, $64 into $3,000. My personal trade that I had put on was $160 into almost 5,000 at the peak. So we also hit some Snapchat trades, the Snapchat calls. We hit those too, about $150 into 800 and about 150% on forward puts as well. That was all in the last week. So if you guys want access to it, like I said, link down below in the pinned comment. That is the sponsor of this video, yours truly. Now let's dive straight into this video. And I think it's important to know that there is two ways that AMC is going to rally, but only one way that AMC is going to go through the end game, the end of AMC, the MOAS. And obviously I'm not talking about the end of AMC, the end of the movement, the ultimate goal, the holy grail of sweet chicken tendies. There's only one way that's going to happen. But first, let's talk about the other way that is going to happen, the two ways AMC could rally. And simply put, AMC could rally because of FOMO buying as well as small shorts covering, but mostly FOMO buying in options. Like we seen back in June, that was a FOMO and option rally on AMC. It's very obvious. The data does not reflect shorts recovering, but instead institutional investors that were even FOMOing in to stocks like AMC, GameStop, your other retail stocks, as well as retail investors and the option chain, the market makers having to hedge out these positions. And that can happen on a any day given basis because of fundamental reasons, a news catalyst. That can also happen just because there is a lot of rumors or retail activity that is going on, as well as institutional investors. And it can happen through market sentiment, right? It's been not in favor of your small and mid cap stocks. There is a chance here in the next couple of weeks, if not the next couple of months, once we get some clarity from the Fed, and we'll talk about that later on into this video, that you could see money just flow from sector to sector, from your large cap tech stocks like Apple, Microsoft, now Amazon, Google, flow from those stocks into small and mid cap stocks. It will eventually happen, no doubt, for sure, because these mid and small cap stocks are so undervalued under their book values. It's going to happen. Who knows when it will happen? So that's really, I mean, to combine like 3 or 4 different reasons into one, that is one way that we see a rally. And that's going to be, in my opinion, a short-lived rally. It could be very explosive. It could send us back to 40, 50, 60, 70, $80. It could give us an all-time high. But does that mean shorts cover? No. Like we've said many times here on this channel, and hopefully other people do as well, shorts do not get forced to cover because a share price of a stock goes up. That's a very large misconception between not only retail, but, well, not only you guys, not only the ape community, but other people as well. It's not just you guys, so don't feel bad about that. It's investors that's been in the markets for 10, 20 years still don't understand that margin calls don't just happen when stocks go up. There has to be something else happening behind the surface to get margin calls. Each individual hedge fund will be a little bit different. Like you've seen with Melvin Capital, they were surely margin called and they had to cover on those short positions at the highest price. So there's obviously a little bit of that going on, but the large players, they don't get margin called because a stock goes up. The only way they get margin called and the end game of the MOAS is when liquidity is dried up. There's a lot of different ways that can happen. That can happen through regulation, like disclosing short positions. Other things along those lines, as far as regulation, laws, pressure on the short sellers, which we're seeing right now. We're seeing a lot of laws that are putting pressure on the short sellers. Like I could imagine, and I would bet to you guys right now, I will take any of you guys up on this bet that these hedge funds that have short positions that don't want those exposed are going to cover in massive numbers, not the ones that have stupidly high allocations of their portfolio in these short positions will cover, and you will see a large pop in all of these meme stocks when that legislation is announced. These hedge funds, they're programming their algorithms to instantly cover once that is published and once that becomes law. That's going to happen. I will take you guys up on a bet on that. But is that going to cause the MOAS? Not in my personal opinion. What will cause the MOAS, the end game MOAS, is when liquidity is restricted and when the stock market comes down. And I know you guys have probably heard that before, and that's why I want to get into the timeline on when this could actually happen, because who even cares if I'm saying this, if it could be 5 or 10 years, which is not, but that's a very long time, or it possibly could be. You never know. But I think we have it pretty much figured out. Now, I do have a lot of data now that I do want to share with you guys. I'm going to make it very easy and straightforward to make sense. So we do have the margin debt. And as we do know, the margin debt hit a high of $935 billion in October 2021. It went down to $918 billion in November and then $910 billion in December. It has not moved around all too much, while at the same time you are seeing a lot of that debt, that margin debt, is just being converted into free credit balances in customers' cash accounts as well as in their margin accounts. These numbers are going up, so people are selling, where they have been a little bit, or taking losses, whatever the case is, on their margin. And that's what really this whole thing comes down to. It's the leveraging that is happening, the over leveraging, I should say, that is happening on a huge magnitude, whether it's banks, hedge funds, Nancy Pelosi and her husband, or anybody else. They're all using leverage and they're in way over their heads. Now, like I said, you see these two numbers going up, you see this number going down. Now, let me take you guys back to March of 2020, right here. And what happened before March of 2020? January, February, and then March. You've seen the margin numbers go down quite substantially from $561 billion in January to $545 billion in February. And then in March, we hit the bottom, March 23rd, of the markets, and the margin debt was at $479 billion. And at the same time, you see this number go up. Both of these times, right? Literally this whole time, the free credit balances and the margin credit balances, these numbers went up from January, February to March, and then they started to go down again right after we bottomed and people started to buy the dip again. So what is this telling you? To sum this up, that liquidity is starting to be restricted, but obviously not at the fast pace that we seen in March. But the leveraging was not nearly as much then as it is now. Everybody is in up to their necks in cheap debt and cheap leverage. You can get margin debt for like 2% right now. If you have margin debt at 2% and you can get let's say a 7% return, then you made technically 5%, and it's basically free money at that point. I mean, you can go throw it into Abivi or Coca-Cola and get over 3% and make a free 1% on your money. as long as your equity didn't go down. Once your equity starts to go down, that's when you see the real problems occur. And I want to put this into very clear perspective. If you see a stock rally and go to AMC in this case, $10,000. Well, if people have hundreds of billions of dollars in their margin account, they won't cover at the top when they lost all this money. Who the hell would do that? Unless you have to, like Melvin Capital. Nobody does that. What goes up comes back down. The key is, can you hold on for the ride? Do you have enough money to hold on for the ride as you go up and you're losing money as a short seller to ride it back down to cover at where your short position was initiated or under that average price of your short position? When liquidity is at its highs, a majority of short sellers can ride that wave. When it's not, you can't ride that wave. You are forced to cover, and your brokerage will forcefully liquidate your position and take their collateral once it gets to those levels. And the banks, the prime brokers, the people that give you margin, they don't care if they know that a short squeeze will eventually come back down and you'll be okay. It does not matter. It does not matter if AMC went to 10,000 one day. The banks, the prime brokers, they want their money. Doesn't matter if they think the stock is going to go down to its previous price the next day. They want to get paid, so that is their utmost priority. But let's talk about what is actually going to cause the markets to come down and what this timeline looks like for the markets to come down. So the markets lately have been pricing in a lot of bad news in your small mid-cap stocks and some of your other different sectors. Pharmaceutical stocks, some of those are beat down if they're not as good of a company, if they're not profitable, if they don't return capital to shareholders in the form of dividends or share buybacks. They've been getting destroyed. So that segment of the market is already in a deep bear market. So there's not that much money there, and that's where the short sellers are shorting their stocks to hedge the overall indices possible decline 20-30%. Certainly on the table. So all of the money, like I've said many times, is in the large cap stocks. Your Apples, Microsofts, Googles, Amazons. So the money's over there. Now, what happens when you have high inflation? This is going to sound very basic to you guys. This red line is inflation. That's when you see the federal funds rate go up. It's literally a direct correlation here between inflation going up and the federal funds rate going up. Now, the federal funds rate is up when things are good, right? This is throughout 2006. I mean, they raised rates from 2004 all the way to 2006 when inflation was starting to go up as people were spending a lot of money before the Great Recession, the global financial crisis, whatever you want to call it. And as soon as that started to happen, rates went straight down. They stayed down for a little while because this was a little bit of a different time where you had banks actually going under. You had a lot of bankruptcies, a little bit different from what we're going to talk about next. But still, nevertheless, you had the federal funds rate going up and then coming down, and inflation that also came down at the same time. So pretty clear there. Now, I do want to hone in on this period right here. From 2015, after the global financial crisis, once the Fed felt like things were okay, they started to raise rates, and they started to raise them quite rapidly in a consecutive basis because what was happening? Inflation was also going up at the same time. So inflation ticks up, the Fed starts to raise the federal funds rate. Now, look at this. When the markets crashed 30%, I think it was closer to 35%. I was in the markets at the time. It was substantially bloody. When the markets crashed, let's just pull this up. If we pull this up to the weekly or the daily gives you a better visual representation of what happened. The Fed was tightening this whole time, 2017, 2018, until 2019, and the markets, 2018, the first time once the Fed really started to do their lockstep rate hike increases, and then it crashed ultimately, the big one in 2019 as well, early 2019. So, and that's 2018, that's 2019. So that's when the Fed actually U-turned And that's when the market started to bounce. And that is where the Fed ultimately cut their rates again. Cut the rates down. COVID hit, rates stayed low. But now, if this was a full chart of 2021 so far, you would see that inflation has shot up to about these levels over here. The line would be in this area. And rates are still low. So what the Fed is going to have to do is possibly raise interest rates higher than the red line. So it is very possible that the Fed is not going to be able to get inflation under control until they raise rates to 7, 8, 9% to combat inflation. That's what has happened in history. You can see this red line is always under the blue line, or at least almost always under the federal funds rate. So the federal funds rate has to go higher than inflation to bring inflation down. And that's where we're looking at a really bad situation. And markets have not priced that in yet. As you guys know, markets are forward-looking instruments, and they've not priced that in yet. So once they price in, that is our reality we're looking at. That's when the markets start to tank. And inflation is just so high now, highest it's been since the 80s. The Fed, quite literally, will not be able to step in and save the day unless you start to see massive layoffs and companies going out of business left and right. The Fed's hands are tied. That means the market gets to fend for itself, and the markets will come down. The markets will crash. That is a given fact. There's no way to go around that. But when will this happen? And then at that point, like 2008, at the bottom of the markets, literally October 28th was when Volkswagen short squeezed. And we like to pick on that one a lot because it's an easy target. As you can see, let's pull this out to 2008. You can see bottom of the markets, right? Over here, October was really where you got that first huge sell down, very, very bloody. If we pull this up to the weekly candles, you can see the markets had just dropped 20% the previous week, October 10th. And before that, they had dropped 8.7% the week of October 3rd. Right after that, literally during this week, you've seen a negative 6% week. Then you've seen those short squeezes happen left and right. Volkswagen, other notable names as well, started to happen back to back. Because why? Liquidity had been restricted in a time of great leveraging. 2008 was the time of leverage. Or, well, 2004 to 2007-ish. The middle of 2007 is really when people started to get a little bit scared. That was the time of leverage in real estate and stocks and everything. Everybody was having a good time, buying boats, buying houses, doing all kinds of things, going on lavish vacations, doing the most because of all this borrowed money. Now, the only difference now is the leverage is still happening, but there's a lot more money in the system. That's the only difference from then until now. But also, you didn't have 7 to 8 or 9% inflation when we look ahead into 2022. So that's the real key. So the Fed was actually able to come in and step in and save the day in 2008. They dropped rates and the market slowly started to improve again. So when you look at it like that, the Fed's hands are tied. And the real timeline of this is when you start to see really bad inflation numbers. And once the Fed really starts to aggressively raise rates, probably by 0.5% at a time after the March 0.25% rate hike. The first one will be 0.25%. The next one might be, and then you're probably that third or fourth rate hike going to start seeing 0.5% rate hike. So as far as the timeline on this, like I said, I expect the March and May rate hikes to be about 0.25% like your typical rate hike is, because the Fed doesn't want to act too fast. They have to get inflation down, but hey, they would rather go a little bit slower and test the waters and see what 0.25%, 0.5% will do to inflation before they dive in and raise rates 2, 3, 4, 5% and crash the economy. People stop borrowing and all of that. So March, May, that's not your MOAS time. In my opinion, that's not when the markets are going to hit their bottom. When the markets do start to come down, and ultimately, in my opinion, hit their bottoms. First and foremost, I do think the markets will start to come down during the June meeting. If not the June, certainly the July. And the September meeting will probably be the lowest. September is also historically our worst month in the stock market. Historically, that's the worst month. By then, you will probably see inflation tapering down, and then you will see the Fed start to say, hey, in their FOMC meeting for November, they're probably going to say, hey, guys, inflation's starting to come down. We've raised rates a lot. We're going to sit on the back burner here and see where this goes. We're not going to lock in another rate hike increase because we don't have to right now. We think we got the situation under control. So bottom of the markets, that's going to be right before Fed Jerome Powell U-turns on us. So that's going to be, in my opinion, either July or September. And that's when you're most prone to see a short squeeze. Now, we have already fallen in the markets and we see how volatile it could be. So we could go down a lot. Really anytime, stay down there a while, go down 10, 15%, and then see that further drop into more of a bear market, major correction or crash territory. And that will be in September, in my personal opinion, if I were to put money on it. But it could be in July as well. And that's when I would expect us to see the most primed MOAS. That's when liquidity will be at its lowest, in my personal opinion. And that's the timeline that I do have for you guys here in this video. That is when I do think AMC will go through the MOAS. And that's why the MOAS is coming ultimately. I mean, we could see short-term pops, like I said, to $30, $40, $50, $60, $70, $80 per share if you just get FOMO buying and option traders that come in. But until the shorts cover, you're not going to see the MOAS. And it's all going to come together at once. Once shorts cover, option traders are going to flock into the stock. FOMO buyers are back, baby. If anybody sold AMC at these prices and they start to watch the thing go up 20, 30% in a single day, they're jumping back in. Come on now. Stock's up 100%. People want to buy it. Literally. They start flocking into it. So I think it's pretty self-explanatory in that aspect. And hopefully you guys found some value out of this video. If not, simply entertainment. That is my thought process. Hit that like button for me. Subscribe to the channel and comment down below. Is there something that I'm missing out of this equation? Because I think it says it all if you watch this video until the end. So that's all. If you guys want access to all of those trades in real time, join a great trading community. Check that out, linked in the pinned comment down below. Love and appreciate you guys. Enjoy your Saturday, and I will see you in the next one.